Ever wonder if lenders are speaking completely different language? You hear words like DTI, LTV, PMI, KFC. All of that sounds like alphabet soup. Today, we will explore the world of lending in home buying process and turn that lender lingo into plain English. Quick disclaimer, I am a real estate agent. I'm not a lender. Everything I share today is for educational purposes only. For official advice and to get pre-approved, you must talk to a licensed lender, which can look at your full financial picture. So let's start at the first abbreviation, PITI. It stands for Principal, Interest, Tax, and Insurance. Most of the online calculation only give you the P&I, the principal and interest. That's why it looks so low. They're missing the big part of it, which is the T and the I. In California, each area, they have their own rate of the property tax. So usually, to be on the safe side, we use 1.25% as a safe estimate of the property tax rate. But remember, it differs from area to area. In some areas, there is a special assessment tax called Meowrealty that will last for about 20-30 years. It will be in the newly developed area, and those money go to develop the school, the fire department, the police department, the roads, and everything. So some area, the tax rate could be as high as 1.9%. You see, that's a lot of difference. Make sure to check before you make decision. And the I after the T is the insurance. If you are buying it with a loan, of course, the bank is gonna tell you, okay, you gotta have homeowner insurance. This also differs from area to area and whether it's a condo or a single family home. The second one is the DTI. It stands for debt to income ratio. So your total monthly debt will be divided by your total monthly income. There are two of them. The front end, meaning that the total debt of the housing itself divided by your gross income. Most lenders prefer less than 28 to 31%. Now, go back to what I said. Most lenders prefer. It's not a rule. So there's exception for everything. I'm just talking in general. It would be great if you can keep it below 28 to 31%. And the other one is the back end ratio. They look at all your debt, not just the housing. So your car payment, your utilities, your streaming subscription, all of that will take into account, plus the housing expenses divided by your total monthly income. They prefer it to be below 43%. Some of them can go as high as 50%, but that is exceptional cases. This is why I said everybody's scenario is different, and it's the best idea to talk to a licensed lender to see the whole picture. The third word is LTV, loan to value ratio. Like the name, it is loan divided by the value of the home. For example, if you're doing 10% down, the 90% will be the loan and 100% will be the home value. So the LTV for this case is 90. Why does it matter? Because if you're doing a loan and you have 80 or less LTV, you can avoid the mortgage insurance on the conventional loan. And that leads us to the fourth word, the mortgage insurance. You might have heard the term PMI, that is short for private mortgage insurance. We will use that term when we talk about conventional loan. For conventional loan, if you are doing less than 20% down, they will require you to have a private mortgage insurance. Now, you heard the word insurance, but it's not there to protect you. It's actually to protect the lender. Let's say if the borrower decided, I don't want to pay mortgage this month or ever again, at least the lender already have some of the PMI from the other payment in their account. For FHA, we actually call it MIP, Mortgage Insurance Premium. Why do you use different words? I don't know. I didn't make that rule. Anyways, FHA required two parts of MIP. The first one is the upfront cost, which would be in the closing cost, and another part is the monthly. Another difference is for FHA, no matter how much you put on the down payment, there's still going to be some MIP. And if you're doing less than 10% down payment, it will stay for the rest of the loan if you don't refinance it out to conventional. But if you do more than 10% down payment on an FHA, the MIP will be automatically canceled after 11 years. Next, we will go over the loan types. The first one, let's start with FHA. It's very popular for its flexible credit requirement. and the low down payment requirement. If your credit score is higher than 580, you can put minimum 3.5% down. But if your credit score is lower, let's say 500 to 579, the minimum down payment could bump up to 10%. The first misconception that I want to address is a lot of people call FHA first-time home buyer's loan. That is not true. It is far from true. You don't have to be a first-time buyer to use FHA. And you can use this as many times as you want. The second myth is you can only have one FHA. That is also not true. You can even have two FHA loans at the same time. Because there are exceptions like you are relocating for work, your family expands, or you're getting divorced, nobody would be able to stop you from having another FHA loan. The next one is the conventional loan. The minimum credit score is around 620. Please note that the higher the credit score you have, the lower the interest rate you will get. With conventional, the mortgage insurance or PMI is usually cheaper than FHA, but they are stricter on the DTI ratio and also the credit score. So it has its own pros and cons. That's why I recommend you to talk to a lender before deciding anything. They can compare what would be the difference between going FHA and conventional for your situation. And for the myth of the conventional loan, people like to say you need 20% down, which is not true. If you're a first-time homebuyer, it can be as low as 3%. And if you are a repeat buyer, it would be 5% minimum. I think the number 20% comes from if you put more than 20% down, you will not have the mortgage insurance. That's why if people can and they would like to, they would put 20% down just to get rid of the PMI. And the next one is the VA loan, insured by Veteran Affairs. It's available for veterans, active militaries, and some eligible spouses. The minimum down payment is, you guessed it, 0%, but there is a funding fee. It's a one-time fee that the VA required you to pay, and it's usually bundled with the loan so you don't have to pay for it out of pocket at closing. Now on the myth, a lot of people say you can use a VA loan one time in your life. That is not true. You can use it as many times as you want. Another myth is you can only have one VA loan. If you want to buy a second home, you have to sell the first one to use the VA loan on the second one. That is also not true. But this also depends on your entitlement eligibility. There are more exceptions on the VA loan, so I will be doing another video just about VA loan. As usual, that's a lot of information. We cover all the terms that you should know about before buying a home and also the nuances difference between FHA, conventional, and VA loan. It's okay. You don't have to memorize this all because I made a one-page PDF loan cheat sheet. You can download it. The link is in the description. Keep it handy so when you talk to a lender, you know exactly what they're talking about. Just a reminder, I do one-on-one complimentary consultation if you want to talk about your situation. Again, I'm not a lender. I cannot give you financial advice, and I can help you prepare for all the questions before you talk to an actual lender. See you at the next video.